NIO stock closed Wednesday at $5.75, down almost 4% on the day. And while the broader markets were weak, this wasn't just another random red session. This marks NIO's ninth straight red day and extends its slide to almost 18% over the past 2 weeks. It's the longest losing streak the stock has had in nearly 2 years. So the question tonight is simple: what exactly is happening to NIO, and is this a sign of deeper trouble or just the market positioning itself ahead of a major catalyst? The first thing to understand is that today's drop did not come from any new single headline. There wasn't a fresh lawsuit, there wasn't a sudden earnings warning, and there wasn't a surprise guidance revision. Instead, NIO is being hit by a combination of market psychology, technical breakdowns, and a rising wave of investor anxiety as we get closer to the November 25th earnings report. When a stock trades heavily in one direction for multiple days, sometimes the story becomes less about fundamentals and more about the momentum itself. That's exactly what's happening here. One of the biggest factors behind today's sell-off is the lingering impact of the dilution that happened back in September. NIO completed a $1 billion share offering, adding around 182 million new shares into the market. That's roughly an 8% dilution in one shot. Even though this happened months ago, the effects continue to show up every time sentiment weakens. Investors remember that move. They worry about whether more capital raises are coming. And when the stock is already falling, those fears magnify. At the same time, NIO's financials, while improving in certain areas, still show continued net losses. Even with record deliveries, even with rising revenue, the company is still not profitable. And the market at the moment is not rewarding companies that are losing money, especially in sectors under pressure like electric vehicles. The Chinese EV market is in a brutal price war. Giants like BYD are flooding the market with cheaper models. Tesla continues to cut prices in China. Smaller players are slashing margins to stay competitive. All of this feeds the narrative that profitability is slipping further out of reach, even if that isn't the full picture. And with earnings only days away, the market is already writing its own story. Another key factor behind today's decline is the technical breakdown. NIO lost the $6 support level and, once it fell through that line, the algorithms kicked in. Stop-loss orders get triggered. Short sellers increase their positions. High-frequency traders push on the momentum. When a stock trades below a psychological barrier, especially one that retail investors watch, it creates its own kind of panic. We've seen this across many EV names over the years. Support breaks, and the slide accelerates. The fall from $6 to $5.75 wasn't driven by fundamentals. It was driven by the loss of that support level. It's also important to understand the broader market context today. Tech stocks were weak. Chinese ADRs were weak. Risk-off sentiment dominated the entire session. When investors pull capital out of high beta, high volatility names, NIO is one of the first stocks to get hit. Today wasn't a NIO story alone. Alibaba was down. PDD Holdings was down. Li Auto and XPeng were down. Even strong companies were dragged lower purely because of macro volatility. When the environment shifts toward caution, stocks like NIO feel it the hardest. But here's the part that really matters tonight. Despite all this red, nothing material has changed about NIO's long-term strategy. The company still delivered strong October numbers. The ET5, ET5 Touring, and ES6 continue to anchor NIO's volume. The company is rolling out its new generation charging technology. Its global expansion continues to push forward, and the company remains on track to report its third quarter results on November 25th. The narrative hasn't changed. The perception has. And that's where the opportunity, or the danger, comes in. The market right now is pricing in fear. It's pricing in the possibility that NIO's margins might look weak. It's pricing in the chance that NIO might miss estimates again. It's pricing in the risk that the price war in China intensifies. But it's also ignoring the possibility that NIO surprises to the upside. The company has already guided for ambitious improvement in the fourth quarter, with the potential to approach break-even on an adjusted profit basis. If NIO shows meaningful margin progress next week, the stock could rebound sharply. This kind of multi-day sell-off has often preceded big rallies in the past. So what does this mean heading into the aftermarket discussion? The best angle to take tonight is the idea that the selling is not based on new bad news. Instead, it is anxiety selling. It is earnings anticipation selling. And it is technical momentum selling. That combination can sometimes create a short-term bottom, especially when retail investors capitulate right before a major announcement. Everyone is focused on the downside. No one is talking about the upside risk. And that is something worth exploring. The key question you want to pose in your video is this: is the market getting ahead of itself on fear? Because NIO is now down nearly 20% in 9 days without any new negative catalyst. Think about that. If the business had deteriorated suddenly, you would expect headlines. If the company was facing new regulatory trouble, it would be public. If deliveries had collapsed, we would know. None of that has happened. Instead, the stock is falling due to recycle concerns that have been around for months. The losses, the dilution, the competition, the missed estimates. These issues are not new. They're simply being amplified because sentiment is fragile. Another angle for the video is that the market may be pricing in the worst-case scenario for earnings. For example, if NIO shows even modest improvement on gross margin, that alone could shock investors. The company has been working to cut costs, streamline production, and scale its newer models. These moves take time to show up in financial results, but when they do, the stock can react violently. The market sometimes only changes its mind when the hard data finally hits the screen. On the flip side, you also want to acknowledge that the short-term risk is real. If earnings disappoint, if margins look flat or weaker, if the company pulls back on its guidance, the downward momentum could continue. But even then, the stock is entering a valuation range where long-term investors may start to accumulate. NIO has traded at much lower levels in past cycles and bounced back aggressively when investor sentiment turned. The business is not collapsing. The company is not shrinking. It is still delivering tens of thousands of vehicles every month. The question is not about survival. It's about timing. As you wrap the narrative, you want to bring the focus back to the central idea of the video. NIO's drop today is not a story about new failure. It's a story about expectation and emotion. Investors are nervous. Traders are hitting stop losses. Funds are reducing risk ahead of earnings. The market hates uncertainty, and NIO is sitting right in the middle of the storm. But this storm could fade quickly if next week brings even a small positive surprise. So tonight's message is simple. The sell-off looks bad, but it is not based on new information. It is based on the anticipation of potential trouble, not the confirmation of it. And that distinction is incredibly important. Stocks often fall hardest before major turning points. Whether this becomes a setup for a rebound or signals deeper weakness will depend entirely on what NIO delivers on November 25th. For now, the market is fearful. But fear can sometimes create the most interesting opportunities.